Line is basically in line, 6.4 billion, 6.44. The expectation was 6.38. The EPS is a slight miss, 174 per share. The expectation was 2.14. If we get to the subscriber numbers, overall paid memberships 195 million. That's a fraction below the forecast of 195.829. So the net adds in the quarter coming in at 2.2 million. The forecast was for 3.26. In terms of the guidance going forward to the next quarter, the paid membership 201 million. The forecast was 202. And in terms of paid net adds for Q4, people had 6.6 there as the consensus, and they're guiding for 6. So just a slight miss there on the guide for paid net adds, and a slight miss for the quarter on paid net adds, coming in at 2.2 million. The forecast was 3.2, and that EPS coming in a little light. We'll keep digging into these numbers. Down 6%, quite a big fall in the after hours market. And Julia is also ready with more of the details as well on these numbers. Julia.
Well, I think the reason why we're seeing the stock sell off so much on the miss on subscriber growth in the quarter and also subscriber addition forecast for Q4 is that Netflix is a company that tends to underpromise and overdeliver. What we're seeing this quarter is that they warned that their user growth would slow dramatically. Last quarter, they added 10 million new subscribers. This quarter, not only was it a dramatic slowing, but it was lower than the 2.5 million subscriber growth that they said they would they expected, and then also the 6 million forecast is down from the 8.8 million that they added in the year-ago quarter, and it is lower than the 6.6 million that they forecast. So they acknowledge this in the letter. They say retention remains healthy and engagement per member household, because that's key, because that points to retention. They say engagement per member household was up solidly year over year in the third quarter. So that means that the subscribers are using it more. They also say the state of the pandemic and its impact continues to make projections very uncertain, but as the world hopefully recovers in 2021, we would expect that our growth would revert back to levels similar to pre-COVID. They also say that their paid net adds are likely to be down in the first half of 2021 as compared to the big spike in paid net adds they experienced in the first half of 2020. So, well, Sarah, as we look at the stock down over 5%, that really seems to be reflecting not just guidance for Q4, but this warning of the tough comparisons to come in the first half of 2021, guys.
Shepard Smith here. Thanks for watching CNBC on YouTube.